So guys, we are going to discuss now about transfer pricing. So let me first give you example of transfer pricing, then we'll go through what is the theory here. And this theory you need to understand in order to solve the question. So here we go, we are discussing first what is the transfer pricing. For example, so guys, let's do we have here company ABC, and this company is manufacturing, for example, shoes. Okay, and this company is having two division. The first, let's say we have here division A, or you can say, for example, factory A, and this factory is manufacturing what, for example, sole of the shoe, this. And then we have a division B, you can say another factory, and this factory is manufacturing the upper of the shoe. And then what they do, they assemble, for example, the sole with the upper end, completing the shoe. Understood? Now please remember here. So division A. So he can sell this sole. He can sell this sole to the open market. Where? To the open market. And he can sell this sole at which price? At $10 per sole, for example. And division B, he has the option, because division B needs sole, right or wrong? Because he is manufacturing only upper and then he is doing assembling. Okay, so division B, he needs sole, so he has option to buy, option to, here this is having option to sell to the open market. But division B is having an option to what? Option to buy from where? From open market. At which price? For example, at $9. Understood? Now what ABC company is doing? ABC company is asking both division to buy and sell the sole internally rather than to the external market. And now ABC, for example, ABC, I'm assuming head office. Head office is asking division A to sell these soles to division B at a price of $9, for example. Actually, this $9 is called transfer price. This $9 is called what? Transfer price. How we can define the transfer price? It is the price, okay, which selling division will charge from the buying division. And this sale is going to be internal only within the company. So the price at which we will sell or buy the product internally within the business from one division to other division. So that is called your transfer price. And transfer pricing is always really complication. And I'm going to show you some problems, what problems you will face here. Look, so if head office is saying that please set the transfer price as what? $9. Now tell me, so which division will gain at $9 and which division will lose at $9? Please, if we will set transfer price as $9, so the supplying division, which is division A, he will lose money here, right? How much money is losing? $1. Why? Because he can sell this at $10 to the open market. But if he would sell at $9 internally, okay, he will lose $1. So, and the buying division, I guess this price is having no effect on the buying division. Why? Because buying division has option to buy from where? From the open market at $9, and same $9 he can pay to the supplying division here internally here, and he's not losing anything, even he's not gaining. But who is losing here? A. Right or wrong? Now, for example, if we will set the price $10, who will lose now? B will lose, because B can buy from open market at $9, but if he would pay 10, so he will lose $1 if he would pay 10 to the division A. And here division A is not losing anything. Right or wrong? Now look, if the price will be, for example, $8. Now division A will lose how many dollars? $2. He will lose profit of $2. But division B, he will gain a profit of $1. Actually, this is the problem in transfer pricing. When you set a price at which Supplying division can sell the items to the buying division within the same organization. So it can create the issue. Issue is what? Issue is the performance. Issue is the performance. For example, if you will set the price $8, so division A performance will be worse because their profit will reduce by $2. Division B performance will be better because their profit is increased by $1. Right or wrong? So that is why here the performance of divisions will be affected. Maybe if you will look the overall performance of the business, maybe it will not affect the overall performance of the business. That I prove at that. But it will affect the performance of division. Now the question can come in your mind. What is the problem if it affects the performance of division? Think if you are a manager of one division and your salary is bonus related, you also have a bonus element. And bonus you can get only if you will reach to the required profit. Obviously, you will not be agree, right? Right or wrong? You don't want to compromise profits. So that is why transfer pricing creates the issue. But transfer pricing creates the issue only at divisional level. Maybe it is not going to affect the overall performance of the business that I'll prove with the help of example. Understood? So this is what is the scenario. This is what I told you the problem I tried to highlight. What is the problem with the transfer pricing? Now we will go through because this theory is required to solve questions. So that is why I'll go through every line with you. I need your concentration. So number one, the transfer prices are amounts charged by one segment or by one division of the organization for goods and services it provides to another segment of the same organization. Like whatever the price is charged by selling division, okay, from the to the buying division, whatever price is charging, and obviously both divisions are within the one company. So that price, the price at which goods will be transferred within the organization from one division to other division, that price is called what? Transfer price. Right? Then the principal challenge, what is challenge? Is determining a price. As I told you, if you will set price at 9, if you will set price at 10, or if you will set price at 8, if one will gain, other will lose. Right or wrong? So this is the principal challenge. Principal challenge is determining a price that motivates both. Obviously, it is not going to motivate both. Right or wrong? It is going to demotivate one, but this is a challenge. How we can motivate both managers, both divisions. Okay, this is going to be a challenge. Now here guys, there are need concentration. So there are 4 types of transfer pricing are there, which can be used as a transfer price. First option is what? These are the most common option. Most common, these, I'm not saying these 4 options are there actually. The first option is called what? You can transfer your product at which cost? At variable cost only. Variable cost of producer. You can transfer at cost, at variable cost only. When it is suitable, when it is not suitable, we'll see. So first option is we can transfer price could be variable cost. Second option is what? Transfer price could be what? Full cost. I also variable cost. What is variable cost? Any cost which will change with the production level. So mostly it includes what? Variable cost may include what? Cost of material, labor, variable overheads. It may include other variable cost. Other variable cost also. All variable cost I'm talking about, not only production relevant. It could be other variable cost. Okay, but full cost include what? Full cost may include cost of material, labor, variable overhead, and what? Fixed overheads also. It is about pure production cost we are talking about. So if you will add all these costs, this is called what? Full cost. Variable cost include all variable, which we also say incremental cost. With cost, incremental cost. And full cost includes what? Variable production cost plus fixed production cost. So transfer pricing can be set as variable cost. It can be set as full cost. It can be set as what? Market price. Obviously, market price may include full cost plus profit. Right or wrong? Or it may be negotiated between 2 parties. 2 parties can sit, seller and buyer, and they can negotiate also. So there are 4 options. How many options? 4 options. First option is which one? Variable cost. Second option is which one? Full cost. Third option is which one? Market price. Transfer price could be a market price also. And the fourth option is what? Negotiated. Negotiate means you have to negotiate. Okay, seller and buyer, they have to sit and negotiate the price and decide the price by mutual understanding. Understood? So here we go. First, we are going to explain, then we'll see the facts of transfer pricing. Don't worry. First, we are covering theoretically. So here we go. What if we set variable cost as transfer price? Okay, variable cost, I told you already, it will include cost of material, cost of labor, variable overhead, and any other variable cost if it is changing due to production. So, but this cost, when it is suitable. So here we go. We need to go through actually, because if I'll highlight the words, so those words you should keep in your mind to solve questions. So variable cost, when it can be used, number one, it can be used only when seller has spare or excess production capacity. Number one. When it is suitable, sir? When seller has excess capacity. Excess capacity means what? Maybe I have 10 machines. And in my routine, only 2 machines are we are using. 8 machines are idle spare. And now maybe I can use those idle machines, 8 machines, because 8 machines are called unused capacity now. I can use that capacity, okay, to manufacture the product, and those product I can then sell internally. So this is the first point. Variable cost can be suitable or is suitable only if the seller is having a spare capacity. Number two, what is the drawback for seller here? Drawback. So obviously seller who is going to sell product at variable cost only, he has no incentive. He's not earning any profit from you. Right or wrong? So he has no incentive for the selling division. There is no incentive for selling division since it will be producing the products at loss, even though the company as a whole will benefit from this arrangement. They are saying, okay, the seller for seller division, he may incur only loss. Why loss? Because he's recovering only variable cost. He's taking only variable cost from the buyer. He's not taking any portion of the fixed cost. So obviously, ultimately, he will incur what? Loss. Because through the transfer price, he's recovering only his variable cost. That's it. So that is why it is loss to the seller, because he's not covering any fixed cost. He's not covering. So here, it's written here again. In practice, companies who wish to follow this philosophy means a variable cost approach, actually adopt a negotiation policy wherein the transfer price will be something greater than variable cost. This is really important point. They're saying that variable cost itself, if you will transfer at variable cost, there is no benefit to the seller. So it is better here to offer some price. Our seller should charge some price more than variable cost. Why? Because for example, if variable cost is $5 and he is charging maybe $6, sale price is $6. So obviously he can earn a contribution of $1, and this contribution can be used to cover the fixed cost. This is kind of suggestion you can say. So he should charge little bit more than variable cost. Try to negotiate. But if you will just sell at a cost, you will incur a loss. Which one? 100%. Yeah, it is slightly more than. Whatever you are covering, obviously, whatever you are earning more than variable cost. So that is going to leave a contribution for you. So that contribution can cover some of your fixed cost also. Right or wrong? Then what they're telling you. So what is the advantage of using variable cost? What is the advantage? The advantage of using variable cost is that buyer is motivated, not seller. There is no incentive for seller. Only the buyer is motivated to solve the company's excess capacity problem. Okay, here, so what is for seller motivation? Maybe seller can say this way, okay, 8 machines are unused, at least I can use it. Right or wrong? So, but buyer is there saying the advantage is buyer is helping seller to use idle capacity. Understood? Then we have here full cost. It is also called full absorption cost. Full absorption cost, as I told you, it includes what? Cost of material, cost of labor, and full allocation of manufacturing overhead. Manufacturing overhead means a variable overhead plus fixed overhead. So four things: cost of material, cost of labor, variable overhead, and fixed overhead. It is called what? Full absorption cost. This could also be the policy. But again, here if you will set transfer price as a full cost, full absorption cost, at least you are recovering your fixed cost of production also. Right or wrong? You are recovering which cost? Fixed production cost also, because fixed cost will also be the part of cost of the product here. Understood? At least you are recovering that one. So here it is written about full absorption cost includes material, labor, and full allocation of manufacturing overheads, which include variable overhead and fixed overhead. Second point is what? The use of full absorption cost ensures that the selling division will not incur a loss. At least he is recovering what? Fixed production cost also. Right? Understood? And what is the benefit of this pricing for the buying division? Think, what is the benefit of this pricing for buying division? So buying division actually he is paying only cost. At least he is not paying profit. Maybe if he will buy from external market, he has to pay the profit also. But if he is buying internally, he is paying only cost. But there is a one negative point also. Because we know, look now from this point of view. I'm seller. I know whatever cost I will incur, I take it from buyer because it is full cost. So maybe I may not be conscious in my cost management. Right or wrong? This is drawback. I'll say whatever cost we are incurring, so we will recover from the buyer. So I may lose control over the cost. Right or wrong? Due to this psychological effect. So this is the drawback of this transfer pricing. Then we have third option, which is called what? Market price. Market price can also be set as transfer price between two divisions. So market price is what? Obviously, market price means the price which you can get from the external market if you would sell to the external market. For example, in my example, as I told you, division A can sell at $10 to the open market. We can sell each product at $10 to the open market. So that is the market price. But point is that buyer would be able to pay this market price or not. This also you need to check. He is ready for this or not. But if you are, now think here, look, when this approach is better for seller first. If seller is operating at what? Full capacity, he don't have any idle capacity. Plus he has customers in the open market. Then he should sell at which price? At market price. Because if he would sell below the market price, he will lose the money. Right or wrong? So if you are operating as a seller, if you're operating at full capacity and you have a customer in the external market also, then the best strategy is what? To sell at market price. Understood? So this is what they are telling you here. The market price is the best transfer price to use in many circumstances. For example, if the selling division is operating at full capacity and can sell all of its output at market price, he has market also, he has external customers also, he can sell. So if this is the scenario, you should sell at market price internally. Then there is no justification to use lower price than the market price. If you have customer also, you are operating full capacity also. So why you would sell at loss? You should sell at market price. Understood? Then alternative. If selling division is not producing at full capacity, maybe if you have idle capacity, the use of market price for internal transfer is not justified then. Right or wrong? Because these machines are spare. So in that scenario, this is not justifiable action. You cannot demand market price. Okay. There's just plus negative points for each transfer pricing. So then negotiation is the fourth strategy. It could be the fourth transfer price which can be set. Negotiation is what, guys? Simply buyer and seller will sit and they will negotiate the price. Right or wrong? They will negotiate the price. What should be the price? So that is called negotiation. Okay, so here they're saying that transfer price need not be based directly on particular market or what cost information. Here you will negotiate. Okay, you will sit together, obviously, both buyer and seller. They will take care of their own interest transfer, and then they will decide the transfer price. And please, I'm telling you again and again, whatever the transfer price is going to be, it will affect only the performance of division. It is not going to affect the performance of company as a whole. Because if on one side division is losing, on other side other division may gain. It overall for company there is no gain, no loss. The reason is that if on one division company is losing, another division company is gaining, so it will not affect. So this is what we are going to discuss now. We are going to discuss now the transfer pricing effect. I hope so. First, I'll read this data with you because here direct solution is there, and I'll tell you which data is the part of question and which what is the solution here. So first of all, so I'm going to read the question. Try to understand, guys, please. So they are telling you a conglomerate refines nitrogen and manufactures what? Fertilizer. Okay, conglomerate actually means it's a kind of merger of two companies in different sectors, for example. Okay. So, or you can say it's a name of company here. I'm not sure in which context it is written. So we have two division here. One is called what? Nitrogen division. Second is called what? Fertilizer division. Fertilizer division, who is manufacturing fertilizer, he need actually nitrogen, and obviously he would buy nitrogen from nitrogen division because nitrogen is used in the fertilizer. So we have two divisions so far. First division is the nitrogen and second division is going to be a fertilizer. And please remember, I'm telling you in advance, this nitrogen division is going to be a supplying division. Which division? Supplying or selling division. And fertilizer is going to be a buying division. I'm just telling you in advance. Upper management, like for example, top management is considering the factors involved in setting the transfer pricing policy. They are just looking at what should be the transfer price. External market exists for both products. Both products means say for nitrogen and maybe for the final product of fertilizer, external markets is there. So they're saying the fertilizer division would like to pay only the nitrogen division cost plus 10%. It is the wish of fertilizer division. He's saying, I'll pay you your cost plus 10% profit. That I'll pay you. Okay, who is saying this? Fertilizer to. So actually, this is the first transfer price we got. Cost plus 10% profit. This is the first strategy. Second is what? Nitrogen division wants to sell at market price. Nitrogen division is saying that no, I want to charge market price. Okay. And fertilizer division is saying no, I'll pay you cost plus 10%. Then when forced to compromise, maybe head office, they are forcing both parties. So management of two divisions settled on an average of two price. So see, one transfer price was cost plus 10. Second transfer price is what? Market price. Third is what? Third option is what they negotiated. They said, okay, no problem. It is not your market price. It is not your cost plus 10%. We'll take average of these two prices. Average of what? Cost plus 10 and market. So average will take. Okay. Then the nitrogen divisions results under the three alternative are calculated as follows. So here I'll tell you what is the data. So first of all, so this is the part of data also. Part of the question. This data which I'm reading here. The cost for all cost of each cubic feet you can say of the nitrogen. This is the cost for nitrogen. Okay, nitrogen will supply nitrogen to fertilizer. So what he told you? So he is buying this nitrogen per cubic foot. How much? For $2. Plus he is incurring variable cost of how much? $0.25. It's a part of question rate actually. And he's also incurring some fixed cost. How much? 0.75. So this is the per cubic foot division cost for nitrogen. This is the cost. This is the cost. And nitrogen, this is also question data. Nitrogen division, he want to sell only how many cubic feet? 10,000 cubic feet only. Understood? Great. Now please. And also, now also market price. Like the market price is what? $4. What? $4. It is also the part of question data. Actually, here we got what? We got the information about the cost of the product. This will be given in the question. And here we got what? Market price of the product, which is what? $4. And now look how you will do it now. This is the data in front of you. Now you would solve. First of all, you will write here nitrogen division. So we have three options here. Under each option, we are calculating. Maybe in exam, you have to calculate under only one option. Maybe they will ask you what is operating income under cost plus 10% option, or what is operating income under market price option, or what is operating income under average price option. But here we are doing for all. So first option was what? Full cost plus 10%. Sir, do you remember what was the cost per unit per cubic feet? It was $3 here given, right? So cost plus 10%. If cost is 3 plus add 10% into that, 10% of 3, it is going to be 0.3. If you will add, it is going to be 3.3 cost plus 10%. Right or wrong? So it means first option is cost plus 10% option. Your selling price per cubic feet is going to be 3.3. And market price, as I told you, given the question, for example, how much? $4. And average, how you will get? Average, you will add cost plus 10% plus what? Plus market price and divided by 2. You will get average. Average is how much? 3.65. Understood? Now what you are going to do? So first calculate your revenue. So what I'll do, I'll take this, if this is the sale price, cost plus 10. If market price is the sale price, if average is the sale price, I'll multiply this sale price with what? With the cubic feet which I'm going to sell. And I told you, we assumed we are going to sell how many cubic feet? 10,000 to the fertilizer division. So we'll multiply with 10,000 under each option. So this is going to give you a total revenue under each option, right? Here total revenue is how much? 330 under cost plus 10% option. And here how much? 40,000. Sorry, here it is 33. Here is how much? 40,000 under market price option. And here revenue is going to be how much? 36,500 under negotiated price option. Ready? Okay, now if I want to do the profit, I'm calculating profit for which division? Nitrogen division. For profit, what I have to do? For profit, for operating income, if I want to calculate, I have to write what? Revenue first. Revenue I calculate under each option. We calculate here 33, 40, and what? 36,500, right? Now we'll deduct here cost. Obviously, cost is what? So our per cubic feet cost was how much? $3 per cubic feet. And how many cubic feet we are selling? 10,000. If I take 10,000 times $3, which is cost, it will give you cost for 10,000 cubic feet. And under each option, this is not going to change. Right or wrong? So we have a cost 30,000. So we got 30,000. We deduct 30,000. We will deduct 30,000. We will deduct. So what you will get here? Revenue minus cost. You will get what? Operating income how much? 3,000. Operating income 10,000. Operating income 6,500. You got it? Now we have another data for fertilizer division also. This we have here, we are done with only nitrogen. Now for please, I need consideration. Now for we are going to do calculation for fertilizer division. Tell me now, what is the selling price of nitrogen division under each option? What is the sale? Sale of nitrogen division. If sale is 33,000, it means it is going to be the cost of purchase cost of fertilizer division. Agreed or not? If nitrogen division is selling at market price, so it means sale is 40,000 for nitrogen division. So it would be the cost of purchase for fertilizer division. If at negotiated price, sale is 36,500 for nitrogen division, it is going to be the purchase cost for the fertilizer division. So this is the first cost for fertilizer division. And obviously, first fertilizer division, he will also incur some additional cost, because mostly when we buy product and then we have to work on it, and then we will convert into fertilizer. So it means these costs will be there under each option, as a purchase cost, plus additional cost is given there. Look, fertilizer division, he will give you this data. He told you cost. There is one purchase cost is there under each option, plus this is additional cost of which division? Of fertilizer division. Additional cost. What additional cost he has? For each cubic feet. For each cubic feet, for example, he is incurring some other cost. For example, he is incurring what? Variable cost of how much? $4. Apart from purchase, like he is incurring additional cost, plus he is incurring fixed cost how much? 0.5. And then, so this is per pound, not per cubic foot. Actually, it is per pound cost. How much? 4.5. 4.5. Okay, don't mix pound with the cubic foot. Maybe in 1 pound more cubic feet we need like that. Okay, whatever data is given, I'm just going to utilize that data. Okay, this is per pound cost. And how many pounds he is manufacturing? He is manufacturing only 5,000 pounds. How many pounds? It will be given in the question. He is manufacturing only 5,000 pounds. And what is the cost per pound? Additional cost? Additional cost per pound is how much? 4.5. Okay, if I want to calculate the additional cost for 5,000 pound, how I will do? I will take 4.5 multiplied by number of pounds, which is how much? 5,000. So this is going to be my additional cost along with the purchase cost. Purchase cost is separate. So this is my additional cost which I will incur. And then what he told you, please, it will also given in the question. He told you this 5,000 pounds he sold externally. What? Externally means to the customers. Fertilizer division is going to sell externally. And he is going to sell at what? $14 each pound. $14. This is a part of question data. And now we are solving. It means this information is given in the question data, for example. How we are solving? First, we have to calculate what is the additional cost he is incurring. Additional cost is how much? How many pounds he is manufacturing? 5,000. And what is cost for each pound? 4.5. So additional cost is going to be 22,500. And now calculate sales. What sale is generating? He told us in the question that he is selling 5,000 pounds to the external people. Obviously, after manufacturing, he will sell it. And he can get how much dollar as a sale price? 14. So sale price is going to be what? 70,000. This is the data. Now we are going to prepare income statement for fertilizer division. Operating income actually. So operating income, how you will calculate? Again, we have a three option. Under each option, we will calculate. If transfer price is cost plus 10%, or if it is market price, or if it is negotiated price. So first we'll take here fertilizer's revenue. Fertilizer revenue information is given here. He is selling 5,000 pounds, and this is the revenue information. 5,000 pounds, and he's selling at which price? $14. So revenue is going to be what? 70,000. So what we'll do here? We'll put it here. We'll put revenue as 70,000. 70,000 under each option. Right? Then we'll deduct here what? Transferred in cost. What is transferred in cost? The sales value of nitrogen division will be the purchase cost of the fertilizer, and the sale value of the nitrogen division under full cost plus 10 option was 33,000. We can recheck here. Go back. 33, 40, and 36,500. This for nitrogen division. So this is the transferred in cost for the fertilizer division. So 33, 40, and what? 36,500. Right? Plus he will also deduct what? Its additional cost. Additional cost was how much? Here is additional cost. He manufactured 5,000 pounds. For each additional cost was 4.5. So it is going to be 22,500. Under each option, this is your additional cost. Additional cost will deduct it. Same under each option. Understood? So now he is going to get here profit. Division's operating income. revenue minus cost, revenue minus cost, revenue minus cost. So this is your operating income. How much? 14,500, 7,500 and 11,000. So see, only profit of the division is changing. Now look, the overall profit of the company will not change under each option. If I want to know overall profit of whole company, as a whole company, so how I will do? Look at here. Go back. I take profit of nitrogen division. Profit of nitrogen division under first option. What is the profit of nitrogen division is? 33,000. No, this is not the profit. It's a sale value. It is a profit. Profit is how much? 3,000 here. This 3,000. Now look at the profit of buying division. How much? 14,500. So it is going to be what? 17,500. Look, under the second option, it will also be 17,500. Go back. Here profit is how much? 10,000 under second option. And look at profit here. 10,000 plus 7,500. Again, this value is how much? 17,500. Then what here? Third option. Here profit is how much? 6,500 for nitrogen. Look for fertilizer. 11,000. So 6,500 plus 11,000 is going to be 17,500. As I told you, it will affect only the performance of division. It is not going to affect of overall business, performance of overall business. Now here we have here minimum transfer price. This is just a rule, like what should be the minimum transfer price. They are saying the minimum price that a seller. By the way, in our question, we have in our discussion, we have 4 transfer pricing: variable cost, total cost, market price, negotiated cost. We know the plus and negative one. And we just told you, we just discussed whatever transfer pricing you are setting, it will affect the performance of division only. Maybe it will not affect the performance of overall company. It can affect only division performance. That's true. Okay, and now here we're talking about what should be the minimum price. Actually, minimum price depends upon various factors. How much you should charge minimum. So minimum I can charge variable cost also. But it depends, do I have spare capacity or I don't have, or I am operating at full capacity. Various factors will affect. So here it is, just small guideline is given. So they're telling you the minimum price a seller is willing to accept is calculated as follows. This is how it is calculated. How it is calculated? Minimum transfer price. You will take first what? You will take incremental cost to date. Incremental cost, I can say like a variable cost to date. Variable cost to date. Then what? We'll add this. So we have to take incremental cost to date, means variable cost plus what? Opportunity cost of selling internally. What is the definition of opportunity cost? Like what revenue you will lose if you will sell internally. What revenue or what profit you will lose. Obviously, we have 2 options. Look at me. I can sell externally. I can sell internally. If I would sell internally, I'm going to prefer this option. If I would sell internally, what I will lose on external sale. So that is for me as opportunity cost. Like profit foregone. Profit foregone, for example, in simple words. So what is the minimum selling price for the seller is what? Seller should take incremental variable cost plus what? Opportunity cost of selling internally. Now, opportunity cost depends upon various factors actually. Which factors? It depends upon 2 factors. First factor is what? The existence of external market. Do we have external market to sell it or not? Right or wrong? Second factor is what? Whether the seller has excess capacity or not. It's just a theoretical discussion. Now, so scenario number 1, please look at here. Scenario number 1. If external market exists, we have external market. But seller has no excess capacity. It means seller is operating at full capacity. And external market is there. Then what is the opportunity cost? Opportunity cost to sell internally is the contribution margin that the seller would have received selling on the external market. In simple word, I said whatever you will lose. Okay, you will lose through the sale through the sale internally. So you are losing on the external market. That is going to be your opportunity cost. Understood? Then there is also they are saying there could be another scenario sometime external market exists, seller has excess capacity. Market is there, but you have excess capacity. Right or wrong? So then what in that scenario, what you have to do? Both segment benefit from any price between floor. Floor means a minimum price. What could be the minimum price? Variable cost. Okay. And ceiling. Ceiling means a maximum price. Maximum price is what? Market price. Any price can be negotiated. If external market exists, but seller has, what it means, just think. Customers are there, but still you have a spare capacity. It means if you will produce more products, you will not get customer. That's why you have spare capacity. Right or wrong? That is why you have spare capacity. Even market is there, but you are not producing. Why? Because maybe customers are not there. That much customers are not there. In that scenario, what we should do? Negotiation is the best option. Negotiate any value between variable cost and market price. It can benefit to both home, seller and buyer. Then what? Sometimes this scenario is also there. Sometimes no external market exists. You don't have an external market. Then what? The seller cannot demand anything above the incremental cost. The reason there is no market for use. So there is no logic. Actually, by the way, as I told you, price can be negotiated also. This is what they are just guidelines they are telling you. If you don't have external market, you have spare capacity, then there is no, the seller cannot demand more than variable cost. Understood? It's not like that he should not demand. He should demand. He should get some profit also, but these are just guidelines. Understood? So here we go. Transfer pricing could be very complicated. We are just studying whatever is required for our exam. Otherwise, there are vast calculations are there. We can produce income statements of both buyer and sellers, and we can see the exact information. Here we have done like something also for nitrogen division and fertilizer division. So here we go. In theory, question I'm just showing. Optimal method of establishing transfer price. Optimal is a max transfer price. What is the max transfer price? Market price. Max is what? Market price. There is no doubt into that, right? Max price, optimal price is the market price. Okay. So this is why I didn't tell you anything about this flexible budget cost. Budgeted cost with or without markup. So it means like you can include profit, you don't include no. That is not max. Max is the market price. Incremental cost means a variable cost. No, it's not a max. It's floor minimum. Ceiling is always max. Ceiling is your market price. Just go through this question, please. So the question is the Eastern division sells goods. So it is a supplying division. Internally to Western division of the same company. The quoted external price in industry publication from a supplier near Eastern is what? 200 dollar per ton plus what? Transportation cost. It means market price is what? 200 plus transportation cost plus it costs 20 per ton to transport. It means external market price is what? 200 plus 20. Total is 220. Understood? Because 200 like a purchase price, 20 is the transportation cost. This is what is the prevailing in the market. Eastern's actual market cost per ton to buy the direct materials to make the transferred product is $100. What it's written, Eastern's actual market cost per ton to buy the direct material to make the transferred product is what? $100. Okay. Actual per ton direct labor is how much? 50. Like if he's buying material at $100, labor cost he has to incur $50, and actual cost of storage and handling is what? $40. So it is going to be 190. The company's president select as what? $220 our transfer price. We think this is selected 220 and 220. On the other side, it is 190 something. And this 220 is what? This is the example of obviously the market price, I would say. It is what? It is the market-based transfer pricing. Because market price is what? 220.
To calculate market price, should you always add the transportation cost?
If it is there, if you have to pay, obviously it will be the part of that. Understood? So then they tell you it is cost-based transfer pricing. No, it is cost plus 20% transfer pricing. You can just check on your calculator. Is it 220 or not? Is it market-based transfer pricing? Because exactly 220 is your market price. So negotiate transfer pricing, it is not negotiated that. Understood? So here we go. So you have another question on your screen. The question is, companies with decentralized autonomous division that sells their goods and services internally to other division of a company. Like one division is selling goods to other division within the company as well as external in the competitive market. So selling division is selling internally and in the open market also. Okay, I have to establish transfer prices for the goods and service transferred internally among divisions. So they want to set transfer pricing. What should be transfer pricing? It means external market exists, right? External market exists. Generally, upper management has established such operating criteria for managing the division as goal congruencies. So subunit autonomy and sustained high level of management effort. So they are saying they set the criteria. An approach consistent with the above criteria, okay, would be to set transfer price equals to what? Look from the seller point of view. He has open market also to sell. So what is the best approach to sell? Variable cost per unit? No, it is not suitable because he has open market to sell also. So market price is more close, right? But let's have a look. Additional outlay cost per unit incurred to the point of transfer plus opportunity cost per unit to the supplying division. What do you think? So they are saying additional outlay cost, you can say incremental cost plus what? Opportunity cost. Okay, let's have a look. Additional outlay cost per unit incurred to the point of transfer plus opportunity cost per unit to the buying division. You have to tell opportunity cost to the buying division or opportunity cost to the supplying division. Who should consider opportunity cost? Supplying and buying. Supplier should consider, right? What is his opportunity cost? Not the buyer, supplier, because he is selling. He should consider what he will lose if he would sell internally. Then what? Full cost per unit incurred to the point of transfer plus percentage markup on the full cost per unit. Actually, I would say this is more close to the market price, right? Definition. Incremental cost plus opportunity cost, it will be close to the market price. This is not the market price. It could be different than market price definition. Understood? So what do you think? What is correct option? Option B. Why not C? C is very similar. But in C, why not C? Because in C, he told you opportunity cost of the buying. No, we should take opportunity cost of the supply. Is that clear? So please practice the question. Okay. Thank you guys. Thank you so much.